Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. I'm recording this on Monday, January 20th, Martin Luther King Day and Inauguration Day. However, it will come out tomorrow, Tuesday, January 21st. I'm going to, and one thing I want to say before I get into this, tomorrow, meaning the 22nd, Wednesday, I will not be doing a market insight video. And long story, I won't go into the detail, but basically I'm switching computers and I had difficulty with the transition of passwords and accessing the websites I use for information, etc. I'll get it fixed, but for this week, there won't be a market insight on Wednesday. So you'll have today's video and that's it. This is interesting. Now, you know that I stay away from things that are political. Well, today's Inauguration Day of President Trump, new administration, and it, certainly has a degree of being political. I think it's what people are watching, what people are thinking about, and so forth. So I'm going to approach this from not so much on the political side, but more on the economic and stock market side. And I'm playing two videos today that I want, or pieces of them that I want you to hear. And one is from Yahoo and the other is from Bloomberg. Now, Trump is on the conservative and Republican side. Yahoo has historically been on the liberal and more democratic side, and certainly Bloomberg has been, because Bloomberg is owned by Mike Bloomberg, who is liberal and democratic. So but both of them took the position of being neutral. I listened to both of them multiple times, and I was trying to find, where is the bias? They should be biased, and I hear a lot of political stuff that's, anti-Trump or pro-Trump or whatever, and personally for me, I get tired of it. So it was interesting to see these more liberal-leaning networks, Yahoo and Bloomberg, being very fair to Trump and looking at both sides, not necessarily pro-Trump, but neutral. And I thought, wow, that is so amazing. That is where we as a country need to go to. And I see Trump doing things that, to me, don't seem like politicians who are catering to to their side, be it Republican or Democrat. So you've seen the people at the inauguration. You've got, Mark Zuckerberg and, Jeff Bezos, and, he's even had dinner, 3-hour dinner with Bill Gates, looking for areas they could agree on. Bernie Sanders came out and said he's going to work with Trump in areas that he agrees on, not everything, but things that he agrees on. And of course, Tim Cook was there. And you look, wow, these people who have been vocal critics of Trump, that I won't say they're embracing him, but Trump is opening the door for conversation with them to work together to solve problems. So that's what I see, and that's what you'll see in these videos from these pundits, I guess, is that they are seeing Trump as a problem solver and looking for ways to work with him, and he's looking for ways to work with them. In my entire life, I have not seen either political party take that approach. Each one is kind of sectioned off into their camp, this camp or that camp, and they tend to bring in people in their administration or hang out with people who agree with them politically. So for the first time I've ever seen this non-polarization and inclusive approach to solving problems. And so I hope Trump is a problem solver. He comes off as trying to solve some big problems, maybe both nationally and internationally. And that's what I want. I mean, I think we should all want a better country, safer neighborhoods, lower inflation, lower unemployment, things like that. So I don't look at that politically, and I see him kind of approaching it the same way. So anyway, I think you'll find these interviews interesting, and so look at it, if you would, more from the standpoint of policies as opposed to, pro-Trump or anti-Trump. So I'll play this first one. This is by its interview. The presentation kind of is done by Josh Schaefer from Yahoo, and again he gives both sides kind of the optimistic view. Now he's looking at the stock market, the optimistic view of the stock market under Trump, and the potential negative side. What could happen both ways, and then what is already priced into the market, and that. In other words, the stock market may not do well for a while. It may go down because what has already been priced in is what we're already experiencing. So we don't know. But again, I thought he gave a good approach to both sides. So take a listen to this, which will include Josh Schaefer from Yahoo.
I guess I will lay out the case, Shauna, for why this time could be a little bit different, right? So we have a story that's going up over the next couple of days explaining how a president has never really entered a stock market like this one, right? So yes, we have a new president come in every 4 years, but take a look at the equity market right now. You have 40% of stocks, or basically 10 stocks in the S&P 500, right? About 40% of the index is just the top 10 stocks in the market. Mm-hmm. Valuations are at about levels that we saw in 2021 and not seen other than that, than the dot-com bubble, right? We're in a Fed period right now where we're wondering, is the cutting cycle over? Could they potentially hike at some point this year? You were just speaking with the strategist who argued that conversation is largely over, but that conversation could come back, right? There's just a lot of things happening right now that don't necessarily have to do with the incoming president, Donald Trump, and don't necessarily have to do with his policies either. Then when you add that in, there's a lot going on there, but I do think you can take the Jeffries note and also spin it positively and think about what Bank of America's Michael Hartnett said today about Trump potentially just being supportive of the stock market, right? And those takes still exist, right? Deregulation is good for financials. Trump's America First policies could be good for small caps. We saw those rallies play out in the month after the election. They dissipated. So now maybe they actually have a little bit of room to run. I think there's a part of this. We had the post-election rally. We came back a little bit. Well, at least Trump isn't entering the stock market at its peak like it felt like he was going 3 weeks ago, right? Some of these trades, financials, small caps, even the S&P 500, are not back at the levels they were peak post-election. So there is a little bit more optimism that is perhaps not fully priced in at that level.
I guess also the question is how much maybe does the strategy really need to change, just given the fact that we could see an increase in volatility because of the fact that we could see more of a whipsaw nature. Maybe it's not the best way to describe it, but back and forth, flip-flopping here, coming out from the administration, and maybe how much of that is going to be preemptively already priced into the markets just in terms of trying to get ahead of the news rather than reacting to it.
Yeah, it's a question of what feels least priced in right now, right? And I think what strategists would tell you is probably least priced in would be perhaps the U.S. economy underperforming, right? If some of these policies turn out to actually hurt economic growth. Right now, the market is sort of positioned for a U.S. exceptionalism sort of trade, probably a strong dollar, probably rates continue to remain relatively high. If those things start to reverse pretty aggressively, I think that would sort of shift the narrative here. So it's really about what has the market already started to anticipate with Trump. So if the dollar keeps chugging a little bit higher, that's not necessarily shocking at this point, right? That's been the trade. Mm-hmm. It's if that doesn't happen, what does that actually mean for the market? And that I think would cause even more volatility, and we'll start to maybe get some of those answers in the next couple weeks, months. I think that's the looming question, right? Is how long does it actually take for some of these policies? Specifically, I'm thinking tariffs. Everyone wants to talk about it right now. It's the big talking point on earnings calls. It was the big talking point in the Fed Beige Book. People are really waiting to hear what happens there. How long does it actually take to get answers? Because I agree, it's going to be jittery until we do.
Yeah, exactly. We heard a little bit from Bessent yesterday, and he kind of tamped down some of those wild expectations when it comes to tariff, me pointing more towards the fact that it could be more of a negotiating tactic. But time will tell. All right, Josh, thanks.
Now, along the same line, David Weston, who is an interviewer at Bloomberg, does an interview with BlackRock's Rick Rieder. Now, BlackRock is clearly, in the political world, they're clearly a liberal organization. And Bloomberg, clearly liberal. Both of them, David Weston and Rick Reeder, are, as far as I can tell, very neutral in this conversation. And Reeder talks about the idea of Trump's policies are to create or approach from an equilibrium standpoint in the markets, not from so much that is going to be good or bad for the market, but it sounded like more neutral. The goal is to achieve a GDP, a growth of about gross domestic product growth of about 3%, which would be very strong economy, probably a strong dollar, probably lower inflation. I don't know all of that, but certainly a GDP of 3%. He points out that demographics play into this, and their demographic shift that's going on will play into the success or lack thereof in Trump's policies. And he points out focus on productivity. Now, AI is going to be used in that to some extent, but I think if we can become more productive, those who are in the workforce with the use of AI or other tools, again, this is going to help us achieve a strong gross domestic product. The thing that I did not hear talked about much was the idea of reducing debt. It is being talked about, and they did touch on it. But if you've heard me talk on this in the past, if they can start to, including interest, because we have to pay interest on our debt, if they can start to reduce debt or even just hold it where it is, we've been going in the hole about $2 trillion a year. If we could neutralize that and not increase debt or begin to reduce debt, that would be amazing, because that is really the elephant in the room as far as our economy goes. So anyway, take a listen to this. This would be David Weston and Rick Reeder from BlackRock.
This is Wall Street Week, bringing you a special edition on what the new Trump administration could mean for global Wall Street. Coming to you from the Cornell Tech campus on Roosevelt Island. I'm David Weston. Growth was a recurrent theme for Donald Trump in running for president this time. Growth in the economy, growth in employment, and growth in the stock market. His pick for Treasury Secretary, Scott Bessent, laid out for us at least part of his plan to get there.
I'm a big believer that for Trump 2.0, that we can control spending by freezing the discretionary component except for defense and moving toward a 3% deficit by 2028. I think that would be music to the market's ears. I think the debt market would respond to that. I think rates would go down. I think inflation would go down. So there's a chance here for a self-reinforcing cycle.
To take us through how Wall Street looks at what Trump policies could mean for that growth, we welcome back now Rick Reeder, BlackRock Global CIO of Fixed Income and head of its Global Allocation Investment Team. Rick, great to have you back.
Thanks for having me.
So I think it's your ears that Mr. Bessent was trying to appeal to. Is he right that if he could bring that off, it would be music to your ears? And is it doable?
So I don't know about music. It's more of a symphony. I mean, it can't be any better. I mean, what the markets care about is there a plan? And I thought one of the key things we said by 2028, there's a plan in place. Oftentimes you have elected officials like, we're going to spend and we're going to do it now. It has to be a progression, but it has to be a thoughtful progression around how do we get spending down, but we don't do it to really disrupt the system, but there are thoughtful ways to get there. And my sense is there's a series of initiatives they're thinking about how to get it down, how to restrain spending, and then come up with a consistent plan. Listen, the debt is the biggest problem. The U.S. economy is in incredible shape. I mean, the vibrance of this economy blows people away. I mean, how many times last year we had a recession? The economy just moves along. There's one risk that's out there, and that is the debt burden. If we have a plan to bring it down, Markets are all about confidence, and confidence that we see the plan, we see the balance, we see how we can create equilibrium over time, and that can't be any better.
So it's a tall order, I think everyone would agree to, even as we say we'd love to have it. But right now we have above trend growth. Can we sustain that over the next 2, 3, 4 years?
So I think the harder one is, can you do it without any price pressure? So the U.S. economy, you think about, we've run, I was looking at, almost every single month for the last year, almost the last couple of years, income growth. If you take the payroll and you look at where income is, it's 5% almost every single month. It's amazingly stable. So can we still run at 2, 3% real GDP? If you see some initiatives around deregulation, if you see some initiatives that are incentivize people to invest both globally into the U.S. and domestically, you can still grow.
So economists tell us that there's a potential for the economy, and it's largely a function of how many workers you've got and how much productivity you have for those workers. Right now we're talking about, if anything, potentially having fewer workers, the demographics, but also on immigration. So can productivity really kick up that much?
So first of all, I would argue that the best indicator of growth over the intermediate term is demographics. When you track what GDP does, it's amazingly sympathetic to the demographics, including, like you say, immigration, et cetera, the age dynamics in the country. But that's over the intermediate term. You can come off that demographic curve because of stimulus one way or the other. So think about what's going on. So will you have some modest reversal in immigration? Probably. But I don't think it'll be significant in terms of aggregate demand. And it really can't. And I can't believe the president will want. There's some real initiatives they're trying to solve for. But I don't think there's going to be a mass deportation of people. So I don't think that is going to be that significant. What I am energized about is I think people think it's going to take longer. I think productivity, everybody talks about AI, but software, inventory management, logistics, technology is changing. People talk about the high profile things like we're going to have driverless cars. But I don't think people talk about other ways that we do business, and even in our business, how we think about documentation, how we think about how we create HR, human resource reviews and things. Like, all of a sudden, we're implementing a whole series of things. We're going to hit an inflection point on inflation, and it's hard to say is that 6 months from now or a year and a half from now. But productivity is going to be the vehicle we're going to drive on to get there.
Okay. I don't have a cartoon for you today. Sorry. I looked up some cartoons. They were all too political for me. So anyway, and then tomorrow, again, I'm not going to have the market insight, and I will return to that next week. So thank you for watching. If you have questions or comments, leave them in the comment section below.